When was the last time you felt completely confident in your agency's finances? Landing huge clients and growing revenue is one thing, but knowing exactly when money's going to come in, when it's going to go out, and how much is actually left for you, that's a whole different story. But like most agency owners I speak to, that question probably makes you uncomfortable because you know you don't have the visibility that you need. That's exactly why I needed to record this video. My name's Rayhan, I'm a chartered accountant and the founder of Sidekick Accounting. We help agency owners just like you make more money and pay less tax with strategic financial management. And in this video, I'm going to show you the exact strategy and tool we use with our clients to help them identify these gaps, plug them, and have full visibility and predictability over their business. This isn't another top 5 tips video. This is me giving you our strategies for effective cash flow management for an agency. If you follow these tips, your cash flow will become your competitive advantage. Why is cash flow so important to an agency in the first place? Well, there's something that I call the cash flow paradox. This is why super profitable agencies still die because of cash flow issues. Most agency owners think cash flow is the same as profit. So they look at their P&L, they see that they've made 20, 30, 40,000 pounds, and they continue, only to find next month they can't pay their team, they can't pay themselves, and they have no idea why. Let me break it down. If you close a 50,000 pound project with a 50% profit margin, that's 25,000 pounds showing in your P&L. Looks great on paper, right? But here's the reality. Your team need paying at the end of the month. You've got software subscriptions that come out all the time, and you've got to pay rent for your office. None of these costs are going to wait. However, your client has some cushy 60 or 90-day payment terms, meaning you're not receiving that cash for a very long time. And it's this gap that is the cash flow paradox and what causes the most profitable agencies out there to fail. And that's why just looking at your bank balance in your banking app or your DIY spreadsheet just isn't enough. You need a system that helps you see around corners and predict the future. So when money comes in, when money goes out, and where there are risks and opportunities along that way. So how do we solve this? It starts with understanding the 3 pillars of cash flow: visibility, velocity, and buffer. Let's break each of these down, starting with visibility. The first step in mastering cash flow is to know what's going on. And that doesn't mean just logging into your mobile banking app in the morning to check your bank balance. Real visibility means having a real-time view of your runway, your commitments, and where there are opportunities in the future. You need a financial command center that gives you this information. So how do you get visibility? Well, it starts with having the right systems, processes, and data available to you so you can interpret what's going on in the business. What also helps is having an accountant or an expert finance person next to you that can help you understand what the data is saying. When you combine these things together, you have true visibility and insight into what's going on in the business. Next, let's talk about velocity. How quickly can you turn work into cash? This is where most agencies are falling over. There are 3 key levers you can use to increase velocity. First is your payment terms. Structure payment terms to maintain a steady cash flow that covers your expenses and doesn't put you at risk. Think milestone payments for projects instead of a lump sum, and think monthly upfront payments for retainer clients. Ideally, that cash flow will come in predictably from something like a direct debit or automatic billing on the first of the month. Second is automated collections. Most agencies have an invoice on their books that hasn't been paid for 180 plus days. They have no process in place to escalate it, but they keep telling themselves they're going to receive that cash. If you have the right system in place, you dramatically increase the chances of receiving that cash. But the reality is, agency owners just don't. And it's super simple to automate and document for someone else to follow. So think about what your threshold is for an unpaid invoice and what your process is when it crosses that threshold. And third is strategic pricing. Build in these timing differences into your pricing so that you're always covered. And finally, let's talk about your buffer or your cash reserves. This is your financial safety net. Now, traditionally, you've probably heard you should keep back 3 to 6 months of your fixed expenses. Now, this is great, but once you've got there, you need a more dynamic and evolved and flexible approach. So once you've got that 3 months in the bank, let's look at how you can make that a bit more dynamic. Firstly, take your monthly fixed costs and times it by 3. For me, fixed costs are your team and any other expenses that you can't cancel within 30 days. Then add your largest project cost of sale, so excluding your team. This might be an external freelancer or agency that's supporting on only this project. And then add another 20% of your fixed costs for opportunities and for surprises, so you're always covered. Now, you're probably thinking this all sounds great, but how do I actually get it in place for my agency? Well, you can implement this system yourself with the information I've just given you. Take action. Or if you're really intentional about maximizing your cash flow and you just don't have the time, book a consultation with the Sidekick team where we'll talk about how we can help you improve your cash flow and grow your business. Click the link somewhere in the description.